Hello, viewers, and welcome to this special pre-budget coverage. My name is Ashwin Mohan, and today we're kickstarting a new series called Unlock Credit, presented by Cred Avenue in association with moneycontrol.com. Everybody is looking forward to Budget 2022 and the announcements that are expected from the Finance Minister. And the theme for today's discussion is solving the enterprise lending and borrowing puzzle in Budget 2022. Clearly, all the industry leaders are looking forward to favorable announcements in Budget 2022 when it comes to managing their respective credit and debt strategies as far as their organizations go. And today, we have a very, very special panel, a panel of stellar experts from the industry who are joining us. So let me start by introducing my panelists one by one. We have Mr. Sanjay Agarwal, Head of BFSI at Care Rating Agency. We have Vibhor Mittal, CBO at Cred Avenue Securities, Irfan Mohammed, the CBO at Cred Avenue, and finally we have Moses Harding John, President and CEO at IndusInd International Holdings Limited. Gentlemen, welcome to all of you, and thank you so much for taking out time and joining us for this very special and interesting conversation. So, as all of you are aware, the budget is an eagerly expected event, and at the end of the day, the budget sets the tone for the rest of the year and, of course, sets the tone also for corporate strategy. So let's kickstart with a broader question, talking about the corporate bond market in India. And this is where perhaps Mr. Moses Harding John can chip in. Mr. John, what are some of the challenges that you think have restricted the growth of the corporate bond market in India? And what, in your opinion, are some of the steps that can be taken to plug the gaps?
Basically, we are in a special kind of situation in the last 2 years. We are operating on a similar top-line GDP as prevailed in 2019, but the borrowing has gone up, pushing the fiscal deficit from around 3.5% to over 6%. That means that the government is accessing more funds from the market. The market borrowing is up from around 8 lakh crores to 12 lakh crores. So from when the state is borrowing too much from the system, that squeezes the fund availability to non-state borrowers. That should have ideally pushed the rates up. Fortunately, RBI was deploying ultra-accommodative monetary policy, keeping reverse repo at an operating policy rate. So that way, the rate upsurge has been controlled by RBI. So this is the operating environment. So if you're looking at the corporate bond market, the corporate bond market is very good at the higher end of the level, say AA and above rating. They have access to domestic market and also foreign market ECBs. So these, being a banker for 4 decades, now I see that no corporate is accessing term loan from banks. They go directly to the market. And similarly, the retail participants also is there from basically the ultra HNI category through aggregators. So the bond market is there for the top end borrowers and ultra high net worth individuals, but it has not percolated down to economic sensitive borrowers, the mid market, the MSME, etc.
So there's a problem with penetration.
Yeah,
so clearly you're saying
to be there. And while deepening this segment, we need to look at 2 things: probably creating an onshore platform on a multi-currency model, covering dollar, rupee bond, dollar bond, masala bonds, everything, and also enhancing the management of currency rate risk, currency exchange rate. I think these are the 2 things that we need to look forward. One is pushing the to the lower end of the pyramid, and number 2, creating the multi-currency platform with the currency hedge opportunities.
Right. Point taken, Mr. John. So Mr. John there with his opening thoughts, speaking about the operating environment. He's also spoken about the need for a possible multi-currency platform. Vibhor, why don't you chip in over there? Do you concur with Mr. John? Any ideas up your sleeve as far as improving the accessibility of the corporate bond market is concerned? Mr. John did speak about the fact that it's available only to a select bunch. How can we improve the access overall to the weaker sections of society?
Yeah. So I think Mr. John hit the nail on the head. So if I was to give some numbers and put it into perspective, right? So corporate bond market today is 35 lakh market, and government borrowings outstanding amount is almost double of that. So it's clearly that private borrowings are getting crowded out because of the government borrowings, and the government borrowings have only gone up in the last 2 years on account of COVID and whatever support that government schemes need to provide and so on, resulting in additional borrowings that the government needs to take. The other issue is that very little participation from offshore investors. So if you see, only 2% of the government outstanding borrowings are held by offshore investors, and the balance is largely being absorbed by domestic investors themselves. So there is a need to bring in more offshore capital to the country, both for borrowings done by the government as well as for regular corporate borrowings. The same thing, that there are only 3% of the entities in India today which are rated at AA or higher level. But if you look at how much share they are cornering in the private debt space, that as much as 85 to 90% of the overall corporate bond issuances. So clearly, there is very, very little appetite left for entities where the rating could be uh, in a category or lower, which is slightly weaker credit profile. Now, added to that, there is also an issue around the secondary market liquidity, which is there, which further diminishes the appetite for lower rated papers. Now, some of the measures that the government has already taken to kind of, and the regulators have taken to kind of improve the market. So, for example, things like trying to create more liquidity by restricting the number of ISINs, by having punched up maturities and ensuring that the number of issuances are lower so that the liquidity and the lot size can improve. The other is advent of EBP platform for primary transactions, nudging some of the investor segments to go to the RFQ
Sure.
platform for doing secondary market trades, and even measures like tightening the disclosure and a security cover related requirements. So all these are steps that have been taken by the regulator and the government to address some of the issues which are there. But at the same time, we need to think through how essentially we empower some of these entities to raise funds, especially these mid corporates and entities, MSMEs, which are rated in the lower categories. So need to provide direct access, by sharing more information, addressing the information asymmetry issue, which is today there,
Right, Vibhor.
ensuring pricing benchmarks so that there is efficient pricing discovery that is happening. Another problem that plagues the markets today is that most of the discussions that happen between the borrowing entity and the investor is a one-to-one discussion, rather than a efficient price discovery, right? How can we cut down on the turnaround time? How can we solve for some of the pain points which are there in executing a transaction? So these are some of the measures I think that we need to address for us to have a much more vibrant corporate bond market in India.
Right, Vibhor. You share a lot of pertinent points. You share a lot of pertinent stats as well. Irfan, why don't you come in over here? You heard out Vibhor. What more do you think can be done on the regulatory front? To get greater participation from overseas investors, which is not as good as it should be or can be.
Sure. So from that perspective, we definitely see a huge appetite potentially coming in from foreign investors, and in that respect, definitely there have been a few initiatives, including that related to gift city and other stuff that RBI and SEBI has put together. Having said that, uh, the real results have yet to be seen, or yet to be seen. So from that perspective, for it to propel further, I think there are a few measures, including taxation, the ease in which one can get approvals, etc., from single window. I think these are two key measures that can propel. That these are the regulatory measures that can propel offshore investors to come in and participate. Today, we have VRR and FPI routes, but they are also, very not periodically, or we don't have visibility on how much gets auctioned and everything. So this kind of transparency or predictability give or certainty given in these kind of auctioning and everything will go a long way. Regarding the gift city that I was also talking about today, in cases of PTC and securitization funds that can be potentially put in, we have to go to multiple regulators, including RBI, SEBI, and so I think there is a definite case in point that can be made to have a single window approval. And then, of course, there is a leakage in terms of withholding tax and taxation, at this point of time. So while we are promoting offshore investors to come in and participate, probably the initial stages could be, relatively easier, promoting or incentivizing and encouraging offshore guys to first come in and then develop the market and then tax them later. Now, with this
Sure.
kind of approach, it is a bit restrictive, is my sense.
So a little more tax friendly, that would definitely help the cause. Sanjay, you closely track the BFSI space. You heard out Irfan. You've heard the other panelists as well. In your opinion, what more can the regulators do? Is there a requirement for more teamwork or more coordination between regulators? Of course, all of them have to protect their own turfs, but at the same time, do you think there's more teamwork from the regulators could help? And also any specific tax ops which you think are missing, that if it is that if they are added, then it becomes a little more feasible for foreign investors.
So I would not have too much of a comment on the foreign investors and the tax swaps, etc. But if you look at the overall structure of corporate bond markets essentially operate on the managed asset platform more than the bank loan or loan market. In managed asset platform, we speak of, let's say, the pension funds, the provident funds, the mutual fund, the insurance companies, etc. If you see in India, all of them are practically public funds. So whether it's the pension fund or the provident fund or the or insurance companies, they are public funds, and they operate. They have to operate at very high credit stakes, and hence their credit risk appetite is extremely low. In India, willy-nilly, mutual funds have also become almost like public funds, and hence a huge amount of regulations have come in. And there also the ability to take any credit risk is very low. If you talk to the fund managers, they are very cagey on taking any risk, whether it's the duration risk or whether it's the credit risk. So with this together, any sort of like Mr. Moses John has said, there is no market below the top notch of AAA or let's say a AA plus or something. Now, you if you move to entities below that, which are the entities that actually need money, the AA's and the AA minus and the A pluses, etc., and which have the credibility to get the money, probably something like an AIF would be a much better route. But if you see in India, the minimum ticket size per AIF is something like 1 crore per investor per AIF, and that restricts the whole market. So I think the first objective to get at least the internal funds, etc., would be to reduce the ticket size per AIF, at least on the debt side. And that would encourage more funds or the more participants. The other issue is the secondary market, as all three of our panelists have said. The secondary market is very shallow, and that also restricts many of the issuers to actually assess the bond market, because there's a risk that tomorrow, due to investor related issues, some of the papers may be floating in the market at very high yield, which could actually disrupt the liability franchise. And then they would rather go with the trusted, let's say, bank market or the limited bond market, limited avenues of funds, rather than risk yourself in the secondary markets and then disturb your liability franchise.
Right. Moses, what do you think is the stumbling block for retail investors who are perhaps rather comfortable investing in equities and mutual funds? What do you think is the stumbling block for them not participating, a little more in the fixed income market? Help us understand what are the factors on the ground which are not really conducive for them.
See, at the outset, retail investors are largely skewed towards equity assets. Even in our public media, we talk about equity and we rarely talk about other asset classes or fixed income or currency or commodity. So that's the major issue. we need to focus on fixed income as an alternate asset class to equities. This is number one. Number two, most of the retail investors who access fixed income are in the low risk, low reward category. So for them, probably RBI retail direct scheme will work if they're okay with the 10-year yield of 7, 15 years, 7.5. I think that's an attractive proposition for a low risk, low reward category. And on the corporate segment also, they may be prefer AAA, AA rather than going into the lower end of credit risk category. So, given this context, the retail play in the corporate bond market is very limited and shallow, and towards a very low percentage of investor class. I don't think the lower end of investors are looking at retail bond market. Probably they're happy with uh, slightly above bank term deposit rate, which they're getting from a shorter end from in the form of NCDs issued by corporates. So, given this context, I think the retail play has to be more on educative level for investors to move away from equity, guiding them to do a diversified portfolio approach in their investment category. That is more important than rest because the infrastructure is good. The connect between the issuer and investor alongside the intermediaries, you have exchanges, you have aggregators, you have securities firms. The operating infrastructure is good. What you need change is the mindset. I think that comes through education and probably talking a lot about in the media.
Right. So more awareness is the need of the hour, and Moses speaking about the fact that perhaps diversification, that word needs to be spread a little more so that investors don't put all their eggs in one basket. Vibhor, what do you think is the potential of the RBI retail direct scheme, which is essentially looking at pushing or prompting retail investors to participate in a larger manner in government securities and sovereign gold bonds? What's the potential of this move from the regulator?
So I think it's a very good scheme, and over a period of time, I do expect some traction to come in from retail investors. Now, if I was to talk about some of the positives which are there in that scheme, right? So one, there is assurance of safety. It is backed by sovereign comfort. There is the investment process has been made very, very simple and transparent, which is anyway essential when you're dealing with retail investors. There are no expenses that are being levied. No, unlike if retail investors go through a fund route where there are some management expenses, etc., which need to be paid. And also, if you compare the returns vis-a-vis today, what you would get in if you were to park funds in fixed deposits, obviously there is a bit of an upside. If you look at the FD market today, that's almost a 157 trillion market. So even if you assume that some of these deposit can move from the banking channel, and can be used by the government, for direct borrowings under the scheme, that would also reduce government's dependency on institutional investors alone, and retail investors, like we know, they tend to be more sticky as well. Another advantage that I see is that there's also an option which has been given to retail investors to liquidate securities post investment through the secondary route. They can. There's a separate platform for that, and bond dealers can buy securities from the hands of retail investors. So I think these are some of the positives. Having said that, there are some constraints as well. So one is obviously that there is a need to create a lot more awareness around the scheme. We saw that the participation from small investors, especially from tier 2, tier 3 cities, in mutual funds started only after AMFI started with this campaign of mutual fund sahi hai. In the same way, I think we need to create a lot of buzz around the scheme, create that awareness in the retail investor community, so that retail investors start pumping in money. The other thing is that obviously in a high inflation sort of a regime, the real returns on government security bonds will always be either close to zero or sometimes maybe negative territory as well. So again, it puts up for debate whether how much sense does it make for investors to park money in such securities. And finally, I think the other disadvantage clearly that I see is that if as a HNI investor or as a retail investor I participate through gilt funds, then I have at least the option of getting benefit in terms of taxation because of the indexation benefit which is there on long-term capital gains tax.
Sure.
Now that benefit will obviously not be there if I'm directly putting in money in government security, and I'll get taxed at the marginal rate. So for individuals who are in the highest tax bracket, that could also be a dampener from a post-tax return perspective. So net, I think it's a good start. I think the scheme will take off, and over a period of time, we would start getting a decent response from the retail investors.
So definitely a lot of potential as far as this RBI scheme is concerned. But like you said, awareness is key. Irfan, very quickly, and after Irfan, Sanjay, you can add. Irfan, now let's shift focus to the budget. When it comes to the budget, what are some of the announcements which you think will perhaps cheer the bond market investors and put them in a party mood? What are you looking at from the budget this time around? What's top of mind?
So I think if I have to summarize what all the panelists have talked about till now, I think incentivizing, taxation, which is incentivizing the offshore, taxation, which is incentivizing the retail market participants to come and put their investment schemes and then be able to rebalance and positively rebalance in terms of taxation and gains that they have. So I think these are the few important pieces that will move the market significantly. I think these are the two things that I would expect from offshore and retail, and from institutional bit, more creating infrastructure that would enable securities to be able to transparently exchange and then giving the tools in the hands of institutional investor. I think these are the pieces that I would expect from the budget. Yeah.
So a lot from the tax department. Irfan, while we're talking about budget and tax swaps, why don't you help us also, understand better the concept of unified lending infrastructure? Can you throw some light on that, please, for us?
Yeah, absolutely. So, so I think we can actually look at the example of what UPI has done to us, which is more like which has taken an ecosystem approach, designed, especially for scale and bringing in efficiency across the ecosystem. So I think looking at that, we can replicate the example there into lending as well, wherein we can build an open tech stack, which is indifferent to any particular instrument. Here it is, we are talking about lending, wherein, again, taking the example of payments infra, wherein about 90+% of payments on UPI are, actually on third-party payments. So if you have to see this from lending infra perspective, I think we should RBI and other regulators should look at building this stack, which is bringing in all ecosystem players into one ecosystem and enable them to be able to participate with each other. Then subsequently, what we have in the OK and OCEN framework, that same can be extended into secured lending domain as well. So bringing this will actually disrupt the existing market, which is bilateral, and put everyone into the same platform, wherein there are tools to be able to assess, because there is data availability transparently. One should be able to assess the underlying borrower and enable that kind of credit offering to that borrower by whosoever is the lending provider. And if you further extend this, there is a skewness in terms of fintech lending for only secured, unsecured player. If you have to bring in secured lending as well, we need to bring in those aspects of secured lending and ability to be able to assess collateral and everything on the same platform. Again, we can take so many examples and learnings from UPI and
Right,
then
exactly.
replicate it here.
Right. Sanjay, very quickly, your top 3 budget wish list, and if you would like to share some views on unified lending infrastructure and its potential in terms of improving lending and borrowing.
Yeah, so I think my first wish list would be to have the AIFs or some such instrument be accessible at a much more retail level, let's say at a 25 or a 30 lakh sort of a ticket size, rather than the 1 crore ticket size which is there right now. Probably some bit of credit guarantee extension should be there, maybe on the partial guarantee structure for corporate bonds, especially for the lower rated entities, and then some additional funding to, let's say, SIDBI and NABARD, to be able to fund the institutions which are funding either the MFIs or the SMEs or CVs, etc., at the lower end, and provide some more liquidity out there. So I think those are the top three, let's say, the budget wish list that I would have. In terms of unified lending, certainly the whole transparency and the information asymmetry which is there in the market, I think that needs to be addressed, and we need to progress ahead on that. And unified lending is certainly one of the requirements. Like we have stock exchanges for, let's say, the equities. For that, we need some more, significantly more sort of institutional and infrastructure framework to take it ahead.
Sure, Sanjay. Now, Moses, if we were to shift focus to digital lending, what do you think can be attempted by the government realistically in this year's budget? We have seen the entire digital segment sort of explode last year. Many of these fintech slash startup companies have hit the markets or are in the process of evaluating an initial public offer. Many of them have also become unicorns. So, Moses, what do you think are some of the steps that the government can take in the budget to further facilitate digital lending?
See, basically, I've seen the transition in banking since 1981. I started my journey in SBI, from moving from manual to automated to internet to mobile and now digital. So, digital, the best benefit for digital is its cost optimization and probably managing the credit cost better, and go to easing the go-to-market access. You don't need a brick and mortar outfit or manpower to access to bridge the lender and the borrower. So what the digital platform how now has emerged is largely towards the unsecured lending and probably financing the raw material purchase and realization of the sales. So this is largely skewed here. But having said that, the if you look at the top line numbers that this fintech and digital is showing on the lending side, it's hardly less than 1% of the total top line. So
That's
that's
right.
a larger play need to go. It has to transit from unsecured retail and personal lending to SMB and move up the channel so that the coverage is high. I think we are in the right direction, and there are huge play for the fintech and digital banking by operators, and banks are also willing to cooperate because they have somebody is there to originate business for them, so they lend their balance sheet and liquidity, so that it's a kind of a partnership between the lenders and the fintech operators. The way forward is good. I look at positive, and although this may not come in the budget radar, I think RBI will look deep into it to ensure that this digital banking gets because we are looking at now next stage of virtual banking. So we need to do the digital banking faster so that we transit towards the virtual banking concept.
Right. So optimistic outlook over there coming in from Moses. Vibhor, what's the Cred Avenue viewpoint on how one can give a bump up, a further bump up to digital lending in the budget, or even in the days post the budget? What are some of the steps that you think the government can take to further push this segment?
So I think most of the steps have been covered by my fellow panelists. If I can just add maybe one point,
Please.
So I think the way this market has evolved, that we've started with unsecured loans, right? And gradually we are seeing how we can move to the higher ticket secured segment. Now, housing loan market obviously is a large market, and if there can be digitization of property records, of land records in the country, that will give a fillip to the housing loan market, because that's what is restricting digital lending in this space. So I think that's one additional measure that can be taken, which will definitely, I think, go a long way in facilitating both lending towards housing loans as well as secured SMB loans, which are backed by property.
Right. Irfan, uh, what do you think can be perhaps attempted in the budget to further incentivize market participants to invest in tech infrastructure?
So that's a great question. For us to be able to go or replicate the success that we've seen in, say, case of UPI, now in case of ULI, and also, to be able to extract the benefits of, tech-based lending and digital lending, etc. So, as ecosystem in totality, will have to invest in solid tech. Today, talk about originators. I'm talking about traditional originators with vintage systems and all. So I see that there is a great requirement in terms of investment in technology. When I say technology, it's just not about having an MIS. So there was a way in terms of managing the entire database in terms of Excel. Then we have ERPs and others. Now we have, fast forward this,
Hmm.
we are getting into, blockchain and everything. So there is a generation of technology that is evolving. So if one has to, build the entire ecosystem, around these generation of technologies, we'll have to invest. So I'm sure, from if I have to look at from budget perspective, the budget should incentivize, encourage all ecosystem players, including the originators, including banks and NBFCs and everyone, to be able to invest in the base infrastructure for them to be able to subsequently get integrated and come onto a common ecosystem and leverage the common platform that one can operate on. So it will not happen automatically. Because if one sees this as an opex item or a expenditure, they may hesitate in terms of investing in this, long term initiatives. That is where I think budget can play a serious role, be it in terms of tax stops or, incentivization in various forms, including the fintechs who are working on providing these innovative solutions. So, there have been many fintechs who have come up with payment solutions. Now, how about, we are talking about digitization? If one has to come up with, furthermore technology solutions in this space to, come and give fruits, we need to incentivize them, give tax stops beyond what is happening in the startup ecosystem, etc., etc. So definitely there is a market out there which is rewarding the startups, etc., to come up with these solutions. But budget also give that kind of fillip to be able to push this. Second point I would like to add is, there was a mention, by one of our co-panelists about,
Right.
especially the digital lenders getting, their share. Today we see that there is a debt flow coming into NBFCs and originators, but if you see what's the share that is coming to smaller fintech with lower vintage, etc., the funding is, not really proportionate or, commensurate to the requirements. So that is something that can be addressed. And of course, there is a talk about FLDG being provided by, LSPs. If RBI also comes in and then, addresses that piece, and then of course, there has to be definitely a checkpoint in terms of how much of FLDG can be provided by by an LSP, especially driven by the network that they have, etc. So I think these kind of guardrails have to be put in, so that, there is a definite structured and systematic push coming in from budget, regulator, and government also. So this is how I would see.
Sure. Sanjay, if you look at this government, since it's come into power, it's always looked at adopting global best practices. Since you're talking about the regulatory framework, since you're talking about credit and debt framework as far as India Inc. goes, do you think there are perhaps any cues that the Indian government can take from overseas jurisdictions and perhaps try and assimilate them in the domestic framework? Any thoughts on that front?
Yeah, especially when you talk of credit, the absence of credit taking funds, there is a significant absence of credit taking funds in India. That market is either not developing or it's not been able to mature to the level which are required. Globally, you see the higher credit risks are taken by funds rather than by the banks. In India, it's reversed. The funds are public funds and they usually take the least credit risk, and Hence, the requirement of the credit risk funding is falls upon the banking system, which is not equipped to do so because it's a balance sheet based lending, and hence they can't do that. The credit risk necessarily has to be taken up by funds, which are pass through entities and which are managed entities. So the government needs to work a lot on it. All the regulators, including the stock capital market regulator, the banking regulator, all of them need to work towards this and provide that framework. And unless that framework comes, we don't see the credit risk market developing significantly.
Sanjay, one more question. Many of these fintech companies that we have spoken about during our discussion, many of them, are really aggressive. Some of them are funded by big private equity investors and investors with deep pockets. Some of them are breathing down the necks of, the traditional banks. Do you also think that perhaps, the legacy lenders need to also pull up their socks in terms of a greater thrust? Some of them already have made a thrust towards digital lending. Do you think that there is pressure from fintechs as far as the legacy banks are concerned to sort of galvanize their business model?
No, currently, fintechs are largely complementing the legacy lenders because fintechs, as our earlier panelists have said, that they have regulatory issues in terms of need to provide FLDGs and balance sheet issues, etc. So the fintechs are new people in the market. The size currently is very small compared to the rest of the market, and a large part of the business is actually neo banking. So they originated on behalf of other investors, and they connect the investors and the borrowers, and hence so on and so forth. And it's also significantly restricted towards the unsecured lending. So means not many fintechs have been able to move beyond the unsecured retail lending to, let's say, SME lending or secured lending, etc. So, and on the other hand, the traditional in India, traditionally players have been aggressive in the tech space, especially, let's say, the private led by the private sector bank. And then even now the public sector banks are coming up in terms of providing co-origination, etc. So other players, since we as a country are strong in technology, so technology is available to us, and legacy players have been putting in a lot of effort. Obviously, they are much larger and hence the pace is slower. But fintechs are today complementary. They are providing the roadmap, the technology, the way ahead to these legacy players. And the model today is not, let's say, opposing one versus the other. It's both together with each other.
Right. Gentlemen, we've had a very, very exhaustive conversation. We have dwelled into several topics, but it's time now for closing comments. And so I'm going to ask each one of you to pick one major step, and I hope there are not going to be any overlaps. One major step that is budget 2022 related, which you can link to our theme, which is, of course, solving the enterprise lending and borrowing puzzle in budget 2022. Let's start with Moses. Please go ahead.
I think I want the budget 22 to be aggressive on asset monetization and divestment, because without that, this budget is not a budget for corporate bond market, when government borrowing is going to get years in executing that.
Absolutely. We have the LIC IPO also coming up, and there are several other jewels, so to say, in the government that are ripe for divestment. So asset monetization, that's something key according to Moses. Vibhor, what's your top pick?
Yeah, I think you asked for one theme. I'll outline two beyond whatever has already been discussed. So one is I would expect, and I think this is the market expectation as well, that the government would clear hurdles for India to be included in some of the global bond indices. So that would definitely enable larger pools of capital coming into the country from offshore investors, because the allocation is directly dependent on the weight that the country holds in some of these indices. So that would be one expectation that I would have. And specifically when it comes to retail investors, some form of incentives. So it could be either bringing the taxation at par with equities, so that bond investments become more friendly, which is that there's no income tax levy on an income up to 1 lakh. Just like there's no income tax levy till the time the profit booked is 1 lakh in case of equity investments. I think that parity is important, and also possibly give avenues to public sector entities to issue more tax-free bonds, in which again there could be
Right.
larger retail participation. So I think these are some of the themes that I would look forward to.
Right. Irfan?
Yeah. So I think, in addition to what Mr. Moses and Vibhor covered, I would say that this is a moment for us to be able to see what UPI did to lending now. So from that perspective, I would expect Budget 22 to significantly incentivize and encourage people to invest in that tech infra and build that kind of common ecosystem platform for us to be able to let that credit thrive, not just for unsecured but secured, and also for corporate debt, because we are talking about only individual credit here, but there is a bigger piece of enterprise credit and corporate credit also, in the form of term loans and all. So I think this budget should incentivize that tech platform, which is promoting various kinds of platforms that are giving into various kinds of decision making tools, enabling data transparency and exchange for better decisions and approvals to be made, and friction free integrations, and building that kind of network density, and subsequently monitoring the credit also. I think this is definitely the moment for us to be able to capture, and Budget 22 should drive this.
Sanjay, I'm not too sure whether the panelists have left any other steps, but do you have something that you think you can add? Your key expectation or hope from the budget?
Yeah, I'm repeating whatever I had said earlier. So I think the government certainly needs to focus significantly on the managed debt space. So probably encourage the AIFs at a much more significant level, and give them a lot of flexibility in terms of size per investor and the protection they need from the markets, etc. So that, I think that is the critical space which is missing today, and that needs to be promoted.
Right. So, gentlemen, with that, we've come to the end of this rather insightful discussion. Unlock Credit, that's the name of the new series. Thank you so much to Sanjay, Vibhor, Irfan, as well as Moses for taking out time and sharing your perspective. And to the viewers, thank you so much for tuning in. Stay tuned to moneycontrol.com for more news, views, and updates. This is Ashwin Mohan signing off.